Hey everyone, welcome to This Explainer. Today, we're taking RenaissanceRe's dense Q2 2026 earnings report, and, well, we're translating it into a clear story of corporate resilience and disciplined execution. It's actually a super fascinating look at how a massive reinsurance player navigates complex global risks and just turns them into consistent profitability.
So we're going to start right off with the bottom line up front. A staggering $654.2 million of net income available to common shareholders. That is a 24% annualized return on their equity. Honestly, when you look at numbers like this, you kind of have to ask yourself, how exactly did a company pull off this level of performance in literally just 3 months?
To figure that out, we'll be looking at 4 things today. Driver 1, underwriting results. Driver 2, fee income. Driver 3, investment returns. And finally, rewarding the shareholders. As their CEO, Kevin J. O'Donnell, points out here, you can basically think of their strategy like a 3-legged stool. All 3 of these profit drivers balance perfectly to support sustainable growth. And by having this diversified income base, they ensure enhanced earnings stability, even if one specific sector of the market faces some temporary pressure.
All right, let's jump right into Driver 1 underwriting results. Looking at the consolidated highlights, underwriting performance absolutely anchored their results. They produced a highly profitable 72.8% combined ratio. So what that actually means is they essentially spent about 73 cents in claims and expenses for every dollar they earned in premiums. That brought in over $599 million in underwriting income alone. You know, in the reinsurance world, keeping that ratio well under 100% is the ultimate goal. So 72.8, that's a massive win.
But there's a really stark contrast between their 2 main underwriting segments here. On one hand, we have a wildly successful property segment boasting an unbelievable 27.1% combined ratio. But then, sitting right next to it, is a slightly challenged casualty and specialty segment at 103.3%. Let's unpack exactly what happened with both of these. Okay, so the property segment was an absolute powerhouse this quarter. This success was mostly driven by incredibly low catastrophe losses in the current quarter, which obviously is always great news. But even better, they experienced massive favorable development from prior year events. We are talking about $257.5 million of favorable development, spanning events from 2021 all the way through 2025. Basically, past risks just ended up costing way less than they initially conservatively estimated. Conversely, the casualty and specialty segment did take a hit. But this wobble in the stool is largely isolated to a specific, highly publicized event. They recorded $58 million in total adverse development. But get this, $54 million of that was a direct shift in loss estimates related specifically to the Baltimore bridge collapse. Factor in another $5.5 million in purchase accounting adjustments, and you can clearly see why this segment temporarily tips slightly over that 100% profitability threshold. Moving right along to Driver 2, fee income. Despite some quarterly fluctuations, which, by the way, are completely normal in this space, RenaissanceRe brought in a robust $83 million in total fee income for Q2 2026. This just proves that their joint ventures and managed funds are still a highly lucrative engine for the overall company. That $83 million was driven by a really solid mix. Management fees brought in $48.1 million, and performance fees added another $34.8 million. Now, both of these were down slightly from Q2 of 2025, but there's actually a very good reason for that. Last year saw a one-time recapture of previously deferred management fees in their Da Vinci vehicle that obviously didn't repeat this year. That, alongside slightly lower net premiums earned in vehicles like Da Vinci and Fontana, explains the slight dip. Now let's look at Driver 3, investment returns. The numbers here are just exceptional. They generated a massive $432.5 million in net investment income. That is actually up 4.7% from the exact same quarter last year. This steady growth is really thanks to having higher average invested assets and executing some really smart portfolio reallocations, like, for instance, increasing their income from fixed income exchange-traded funds. And their $121.6 million in total realized and unrealized gains is pretty much a perfect story of diversification. Huge wins in equities, generating $217.3 million, and private equity gains of $99.9 million, completely absorbed and offset the losses they took elsewhere. And those losses included $115.3 million in fixed maturities due to increasing market yields and $79.1 million in commodity losses, which principally came from a dip in gold futures. But as you can tell, the winners far outpaced the losers, Which brings us to our final topic, rewarding the shareholders.
RenaissanceRe aggressively bought back their own stock. In Q2 alone, they repurchased $350 million worth of common shares at an average price of $300.82 per share. Let me tell you, when a company buys back this much stock in a single quarter, it signals immense confidence in their own balance sheet and their future prospects.
To truly put their capital strength into perspective, let's zoom out for a second. Over the last 2 years, they have repurchased 11.5 million shares. That is an aggregate investment of approximately $3 billion, meaning they have effectively retired 22% of their starting share count. 22%! That is a massive return of capital that directly increases the ownership stake and value of every single remaining shareholder. So all of this disciplined execution, from the pristine property underwriting to the fee management to the investment gains, and finally those share buybacks, it all culminated in a 5.7% quarterly growth in book value per common share. That brings this critical valuation metric to a record $264.77. Which leaves us with one final thought after digesting all of this dense financial data. When you look at a quarter that includes localized pressure from a major disaster, like a bridge collapse, and a dip in global commodity markets, what does true, resilient corporate execution actually look like? Well, it looks exactly like this. It's leveraging a perfectly balanced strategy across underwriting, fees, and investments to consistently compound tangible value for shareholders quarter after quarter. By relying on diversified earnings, RenaissanceRe proves that a sturdy three-legged stool can weather almost any storm. But as global climate volatility increases and commodity markets remain unpredictable, the question isn't really whether another storm will hit, but rather which companies have the discipline to build a stool strong enough to survive it. Thank you so much for joining me for this explainer, and I'll see you next time.